Okay, we're starting to record, but I'm running behind, so let me get a book and a couple of things to go over with you. All right, let's officially start class, I guess. This thing works good when it works, but this morning in principles, it just pops up and asks for a password. And I put it in a month ago, and so I was locked out. I had to reset my password so I could get in and do it for this class. So I just got that done. Anyway, let me tell you what's on the test here. Okay, I'm going to give you what problems are on here. No multiple choice this time, just problems. I hate to grade all those problems, but I'll have to. Okay. All right, problem number one is journal entries. Journal entries such as purchase of material or putting payroll in the working process and putting overhead in the working process or your applied rate in the working process.
Journal entries.
Journal entries. Normal journal entries that you always have. At these in manager only at a review and cost. Okay. We'll transfer the finished goods and then we'll sell them. So that's problem one, journal entries. Problem two. Prepare a schedule of cost of goods manufactured. All right, what do you put on the statement of cost of goods manufactured? Is both of your buddies gone today, Tam?
Eric booked her plate, Olivia's a second.
I know Olivia had been gone today. Eric's order?
Eric booked her plate, he'll be here.
Oh, we woke up late. Well, anyway, Dana and Caleb did tax returns last night until about 7. It's pouring the snow out, but it would quit before I got home and start buying, quit and start buying. And this morning at home, I had nothing but the grass is partly covered up here and it has. So, but anyhow, problem two, what goes on a manufacturer's statement? Materials. Now first, how do you find out how materials are used? I'm just reviewing with you a little bit as we go along today. Let me bring up one note here, which will probably be better for the situation. All right. You take beginning materials, inventory, which I have on here. You add purchases, which I have on the test. That gives you materials available minus ending inventory gives you materials used. Now that's what goes on your manufacturer statement, materials used. Now, if this were 100,000 and indirect materials were 2,000, I would subtract, but I didn't put that on the test. So you don't have to worry about taking out indirect materials. you go through this format here, you've got your materials. So now you're going to put materials on the manufacturer statement, and you're going to put labor and you're going to put overhead, right? Now the labor is given. You may have to calculate it out. The overhead cost is given, a one-liner. You don't have to pick out items that are overhead, one-liner. So that is your problem 2 on the test. You got a heads up on it. Now guess what problem 3 is? Problem 3 will be the high-low method. No tricks on it, no minuses or anything of that nature. Now, the only thing I put in here, let's say you find variable cost is equal to 2x, and your fixed cost is always 5,000. All right, your fixed cost is always 5,000. Your variable cost is 2x, or even $2 times the number of units. Let's say I gave you a number of units of 700. Find the total cost real quick. With what I have scribbled down here, find the total cost for 700 units real quick, okay? All right, 5,000. 2 times 7 is what? 2 times 7 is what? 14 plus 5 is what? 1,400 plus 5.
Oh, plus 5.
Yeah, 6,400. That may,
5,000, yes.
yeah. All right. Now that's the only other thing I might throw on that high-low method, that you do find that cost. Okay, that's problem 3. Problem 4. You're going to be given an overhead rate. And you're going to be given the actual overhead. And you're to find over under applied. And you're to make an entry to get rid of that over under applied.
You're given the overhead rate.
I'll give you the overhead rate. You don't even have to calculate it.
Okay, the actual overhead. And then what do we need to calculate?
Then I'll give you the actual overhead. Now you apply this overhead rate, then you apply the over under. Now, if it's in material and you make a journal entry, what do you take that over under? What do you put it into or take it out of? If it's insignificant, cost of goods sold, remember? Now, if it's significant, you take it, split it between cost of goods sold, finished goods, and work in process. All right, so that's problem 4, applying overhead, getting the over under applied, and making the journal entry. All right, problem 5 is easy for you, okay? I've got a bunch of expenses down here in the amount. And you're to tell, all you gotta do is right beside of each expense, whether it's B for variable, F for fixed, or M for mixed.
If they're fixed variable or mixed.
Fixed, variable, or mixed. What's an example probably of a what's an example of a variable cost in any business? What's cost of goods sold? Is that fixed, mixed, variable? That'd be totally variable, wouldn't it? Sell 10 units, sell 100, cost of goods sold is gonna be different. All right, what's normally a fixed expense?
Depreciation.
All right, we'll always take depreciation as a fixed, that's our the expense. However, we know it could be variable if you were basing it on units of production. Your straight line is fixed. Or if you're using the MARS table, which we'll get to in tax. If you're using those tables, then depreciation will never be fixed. So, but for our studies, depreciation is fixed, assume a straight line depreciation, 2,000 every year. All right, once you know that's always the case. Give me an example of a mixed cost.
For example, electricity bill.
Well, utilities would be mixed, have a base amount. And then what you go over, you know, you can pay more. Same with your water bill, maybe 25 a month, if you don't use a month, you can start using more, maybe go to 35 a month. Anyway. Does any of your parents or whoever you're living with, does anybody complain about their electric bill this winter? Of course, you all rent, you don't have to worry about electricity, do you, Giorgio? Yeah, I think everybody else complained about electric bills this winter. Huh?
Yeah, higher.
A lot higher, yeah. Robert, Tana, do you all have Appalachia Power up here? AEP? Yeah, AEP. You see, they're a monopoly. We know that. They're a monopoly. The only way you can compete against them is try to get natural gas into your house or burn wood or something to compete a little bit against Appalachia Power Company. All right? But I think their rates are too high. Okay, so you know what number 5 is? Number 6. All right. Now, we went over this yesterday, Tuesday, that is, and I'd advise you to go back and look at these couple of problems. Now, here's the deal. Determine the amount of over, under applied overhead using variable costing and using absorption costing. This is probably your hardest problem. All right. Determine the amount of under or over applied fixed overhead using a variable costing and also using absorption cost. So we went over that the other day, and I felt like Giorgio had a good handle on it because he was answering everything where this fixed came in and when fixed didn't come in on both methods.
So the amount of overhead, like fixed, over applied or under applied, fixed overhead.
Determine the amount of under over applied overhead, fixed overhead that is, using variable costing and absorption cost. Now, number 2, underneath that, prepare an income statement projected for variable costing and absorption cost. All right, that's your 6 problems, folks. They will count equal values. I started to put on our reconcile the incomes with variable and fixed, but I took that off. I think you'll have enough to do. So get here as early as you can on Tuesday. If you want to come real early, I've got accounting principles, but there'll be plenty of seats. I can get you started. Anytime you come here between 9 o'clock and 11:30, I'll get you started. Okay? All right, there is your 6 problems. Any questions, Giorgio?
I'll take the notes from one. I missed first.
Oh, okay.
It was, yeah, it was.
All right. All right, you know what they are. And those folks out there live streaming, and I'm sure Tanda will bring Olivia up to date. So you know what they are? Study for them. And many of them are overlapped with managerial. Now, did we have any other assignments, Kayla, in chapter 3? Did we have any assignments in chapter 3? All right, I thought I gave you some more information there to review. What are they, dear?
41, 43, and 48.
To give you a break on this test, I was looking at what I assigned. Number 1 and 2, I counted 20 points apiece. 120, 220. 3, 4, 5, and 6, all 15, 15, 15, 15. So you can blow one problem out of the water and still make a B. You can blow 2 problems out of the water and still make a C if you miss 2 15-point problems. So 4 out of 6 will still give you a C. So you got all kinds of ways here to do okay on this test. Okay, let's look at these problems. I guess they're starting on page 96, 97. Okay, you said we have problem 41, under, overapplied, overhead, and of course, disposing of. You've got all kinds of items listed here, your variable indirect labor, your variable indirect materials, and all your fixed stuff. And most utilities that had there was fixed. Mixed costs, depreciation fixed. There's some variable utilities, no, it's fixed salaries. All right, the company allocates overhead to production using machine hours. For 2013, machine hours have been budgeted at 50,000. Now you've got some instructions here. Determine the predetermined variable and fixed overhead rates for Grant Island. The company views separate variable and fixed manufacturing overhead control accounts, or it maintains. All right, you got 50,000 units. Machine hours. You divide that into what?
Total variable.
Did you just add up those 1, 2, 3, 4, 4 variables?
Add up variables and you add up fixed costs.
All right, those variables add up to be, looks like 320. Now you can eyeball that and see that adds up probably to 320. All right, and you're going to divide that by what, 50,000? All right. So I just always get rid of these zeros. 1, 2, 3, 4. I've got 5 into 32. 5 into 30 we know goes 6. And 5 into 20, 6.4. Okay. Now, 640. What is that? Is that dollars?
Yeah. No, that's
Units into dollars. No, we'll give you $1. That'll give you $1 amount. If it were dollars into dollars, it would give you a percent. Okay, now if you add up all the variable fixed costs here, 62, 13, 16, 75, 12. I can't add that fast on those. What is it?
178.
50 into 178 then, I'd get rid of zero. I'd divide 50 into 178 goes what, $3? $3.06.
56.
56. Now, does that continue to 6666?
No, it's 56.
6 even. All right. If I can get down to this and quick enough, let's look at the first part. All right. This was all of your variable 320, and that rate was the 640, right? And then your next rate should be your 356. Okay, so it's easy to calculate overhead, Larry. It's easy. Now use it, okay? All right, on B part, the company used 53,000 machine hours during production cost, incurred a total of 273,000 of variable overhead and 185 of fixed. Prepare journal entries to record the incurrence of the actual overhead and then the application of overhead. Well, what do you debit for actual overhead? You debit
Overhead account.
actual overhead. Variable control or fixed control, and you credit various accounts, whether it be accounts payable or accumulated depreciation or cash or whatever. All right. Now, when you record the applied overhead rate, you debit what?
Work in process.
And credit?
Overhead control.
All right, so here's your 4 journal entries. Factory overhead control, variable, and fixed. Now we're putting it into work in process using the applied rate. All right, you can see 273, 339, there's going to be some over under, right? And you can see 185, 188, there's going to be a little over under, but not bad. Okay. Next question. What amounts of under over applied overhead exist? That's easy. All we had to do is subtract there and get them. Make yourself a T account if you need to. Actual, applied, different, over applied. Actual. This is actual. This is applied. That's definitely over applied. Actual, applied. You can see that's over applied. All right, now how do we get rid of that?
Depends if it's material or not.
Okay, now D part, close fixed overhead at year end. That is to take it out of cost of goods sold. You see, we put 188 into cost of goods sold. Up here, we put 188 into cost of goods sold because that's where work in process ends up. Finished goods. So now we're going to take 3,000 out of that 188. It brings it down to actual 185. Now, management believes that the variable overhead amount calculated in C should be considered material and should be prorated. Now, prorated to what? At year end, We have materials, work in process, finished goods. Now, a company can take anything they want to prorate, but usually the big three is work in process, cost of goods sold, and finished goods. And I'm glad they're not using materials, even though they gave it to you. Materials are already in everything up here. Materials is in work in process. Materials is in finished goods. Materials is in cost of goods sold. So it's already up there. All right, so here we just add them up, divide 1,560,000 in all the three, and you'll get percents of 15, 25, 60, and you multiply, and you make your journal entry.
As far as the journal entries that you said that are in the first problem.
So what now we're into?
As far as the journal entries that you said are gonna be in the first problem, are gonna be like journal entries of this kind, or journal entries like moving the raw material and account payable and like work in process?
That is your first problem.
So that's gonna be more of this than.
Now, first problem will not have this.
Okay. All right. There's not gonna be like fixed.
No, first problem is just buying materials, issue material, putting labor in the working process, put working process at finished goods in themselves. But you will have this in another problem. Should be in another problem.
Yeah, that's.
Okay.
Yeah. All right.
Let's see what problem. I took up some problems the other day. Okay, 41. Any questions? All right, 43. The high-low method. Now, there's no need to spend a lot of time on number 43. All right, you find the high and cost, the low and cost. The difference is 4,160. Divide and get 320.
I think we had this in the previous homework assignments.
Oh, did we? I thought she told me 43 was due today.
It was due today, but it was also due on Tuesday.
Oh, okay. That's all right. But anyway, you need to test this out to find that your fixed cost then is 4520 at every level. It should work at every level, but it don't necessarily, okay? They're just making up problems. They're not getting the exact numbers that works out for us. But now, is there a B part using the least squares? Yeah. Now, we said the other day, we wouldn't use the method of least squares, but in the method of least squares, X is your units, Y is your dollars. X times Y is dollars times unit. X squared is 1,400 times 1,400. Now that's items you put into your formula, okay? X, Y, Y times X, and X squared. But anyway, you're not responsible for this. Have you ever done anything like this, Caleb? You have? And do you do it in stats?
Statistics, yeah.
All right. You don't do it in quantitative techniques?
You
I
do
doubt it.
calculus.
You do it in calculus. All right. But anyway, to finish out the formula, here's what you come up with. $3, no, that's plus that to work out that formula. But anyway, we won't mess with the method of least square. Okay? But it looks like it gives you a more exact figure though, and more exact to be used everywhere. Okay, and you had number 48 for today. All right, now this was the last problem I think I put on your test. This is one I said we looked at briefly on absorption and the variable costing. So let's look at 48 pretty careful and please ask pretty questions. Okay. Bird's eye view manufactures satellite dishes used in residential and commercial. For each unit, the following costs apply: $50 for materials, $100 for labor, and $60 for variable. The company's annual fixed overhead is $750,000. All right, its capacity is 12.5. Now that is the expected capacity. All right, produced as the basis for applying fixed overhead. A commission of 10% of the selling price is paid to each item sold. Annual fixed selling and administrative expense are 180. Here is a breakdown: selling price, number of units sold, number of units produced, beginning inventory units, and ending inventory units. Prepare pre-tax income statements under absorption. Now, this is what I'm asked you to do on the test. You will be preparing income statement. Absorption is an old income statement that we've always had. All right, let's look at the absorption. 10,000 units and 12,000 units. What was the expected number of units?
12,500
12.5 expected.
capacity.
All right. For 2013, it was 10. Is that actual? Is 10 the actual?
Yeah, 10 is actual.
And 12 is actual for the next year. All right. Now, cost of goods sold times $270 a unit. Now, where did that 270 come from?
270 is direct materials plus labor plus variable overhead, and then annual fixed overhead divided by 12.5.
All right, so that is your $50 and your $100. There's 60. That makes 210.
And then plus 60 of fixed overhead.
All right, that makes 210, but we need 60 more dollars.
So, yeah.
And that comes from 750 divided by your expected of 12.5. I soak that in for a minute. And then naturally, the underapplied overhead was 0. So our cost of goods sold is officially $2,000,007. Our gross profit is officially $2,003,000. All right, now where do we get to $50? Is that given?
So
We have to calculate.
that's a 10% fee for each unit sold. You pay a 10% fee for each unit sold. So 10% of 500 is 50, and multiplied by the units is the cost.
10% of 500 is 50, but no, where are we getting the 500 from?
You multiply 500 is the selling cost.
All right, that's your selling price. 10% of that goes to commission. 10% of 500 is, and that's why we call it variable then, isn't it?
Yes.
Because it could have been less units. Now fixed, where's 180 come from?
Fixed. Oh, it's given.
Should be given. All right,
Well, why didn't we have any underapplied overhead or overapplied?
we'll get to that. We'll get to that in a minute. See. So concentrate for a minute on 2013. Okay. right, now let's look at the income statement first for 2013. Now this is what?
So,
Absorption. Now let's go down and look at 13. Absorption, remember, is what we've always done. Sales minus cost of goods sold gives us gross profit, minus selling administrative gives us income before taxes. Always done that. Now, let's see how it changes. I want you to see how it changes here. Your income under absorption is 1,620. But your net income under variable is 1,470. Now, first off, take the 1,620 and subtract out the 1,470,000.
$150.
Now, let's see where that 150 comes from if we can. Okay, but first, let's look at the differences. Okay, let's start with sales is the same under both methods, of course. Cost of goods sold is not the same. It's two.
Yeah.
Now, what are we taking out right here? 270, 210. $60 was the what?
Fixed overhead.
The fixed cost. Okay, so we're getting a different GP, contribution margin here, but gross profit up here, it's contribution margin here. All right, you take out variable and you get contribution margins. Now, gross profit and contribution margin are two different things. Now we're going to take out variable selling, which is still 500, right? Now this is just total contribution margin. Now we're going to take out, this is all variable costs. Now we're going to take out fixed costs. Now up here, if we have selling administrative 180 for fixed, both methods. But up here, variable costs, we'll add the 500. Okay, for selling administrative. But here, factory costs 750. They give you that. That's in the book, isn't it? They give you 750. So here we have 250 or 150, 1 million.
Yeah, the difference in that income.
What? 150,000, not a million, right? Now, can you see where that 150 comes from?
Is the difference between the beginning and ending inventory. We had some leftovers in the inventory, we had more inventory in the ending, so.
Well, here's the difference in beginning and ending inventory.
2,500.
Now, multiply that 2,500 times what?
60. Fixed overhead rate.
All right, 2,500 times 60 would
That's
be
150.
150. Don't actually do that on a test, but it's good to know that. All right, but both of you do get income. This one you get a gross profit, this one you get a contribution margin. Now we got to go back and look at 14 next year. The next year, we're going to do better and sell 12,000 units. We're still going to sell them at $500. Cost of goods sold is still $270. But we got one thing different here. We had zero over here. Where does the 90,000 under applied overhead come from? We got to know. What is your actual overhead? Is your actual overhead 3,240,000? Is that your applied? I mean, is your actual cost of goods sold 3,240,000?
Yeah, that's
Actually. All right, take a minute, dig into problem 48. See if you can find the actual overhead and the applied overhead. We gotta come up with $90,000 under applied. So let's read the problem again and see where it comes from. Georgia, what'd you say the rate was for fixed overhead? What's the applied rate?
$60.
Well, no, it's, $60 for verbal overhead.
It's, yeah, and for fixed is 60 as well.
Was it?
750,000 divided by the expected capacity.
That's still 60.
That's
So that's 120, right? 120? Would that be your overhead predetermined rate, 60 plus 60?
yeah.
Right. Now try multiplying 60 plus 60, which is 120, times the 12,000 units. I don't know if this is working on it. It sounds logical.
120 by 12,000 units.
Well, yeah, 12,000 units, yeah.
That's $1,440,000.
1 million what?
$440,000.
All right, if that was applied, we're gonna find actual. Is there anywhere we can dig out actual overheads, subtract that from? Got to apply, we gotta find the actual. I'm missing something here, let's see. We know we got 750 fixed cost, which is actual. And your actual variable, you're gonna add something that's 750. How do you find your actual variable? Okay, here is your challenge once again. How do you find this 90,000 over under applied? Now here's what Georgia and I did a minute ago, the 150. It's 2,500 unit times 60. Now the same thing works for 2014. But that's still not helping us get over under applied. But we can do all the problem sounds, and we're making this hard for some reason. $90,000. We gotta find $90,000. It should be easy. They give it to us. Georgia, the multiply 120 times 12,000 units.
Yeah, it's like 1,440,000.
All right, now that has to be your actual. Because, I mean, you applied, right? They gave us 60 verbal overhead, and we calculated 60 fixed. So that would have to be your applied, right?
Oh, that will be a point, yeah.
That'd be your applied. Now, we were under applied, so add 90,000 to whatever figure you got there. Add the under applied to that figure.
$1,530,000.
At 1,530,000 should be your actual overhead. Now, how do we get 1,530,000? We gotta find that actual overhead. I'm just working backwards. 1,530,000. Actual overhead. See, the fixed overhead cost us 750. If we use the expected capacity of 12.5, that's where we got $60 in the first place. Any look here? Evidently, they expect us to see that. It's so easy to, none of us is seeing where that comes from. They just don't pick a number out of clear air and put in 90,000 under applied factory overhead. The only thing we have to go on is that $60 rate. Okay, we're gonna have to leave this problem. Please find the two overheads that give us 90 difference between now and 50. I know somebody you can do that. It's a challenge too. Okay. If you do that, that's 5 points extra on your test. If you find out where that 90,000 comes from.
By the way, are we gonna have like any notes for the test?
Probably not on this first one, since it's a repeated material, so probably not, just bang a calculator. All right, so we're going to, I will not give you anything like this on a test that wasn't mentioned. You'll be able to find the applied and actual overhead with these. I would not bury it somewhere like this where you have to figure out.
I was able to calculate the net income difference between absorption and variable. It was 60,000. 14 years, 60,000. Yeah, I wrote that up. Right there, differences in income.
So we did the 150.
And 60,000.
Same thing. So your inventory went down here 1,000 times the 60. Here your inventory difference was 2,500 times the 60. That's just an inventory difference to give us the difference in net income. All right, so I'm gonna let you all go today. I've got to record an accounting principles lecture. So I will close this out and stop the hangout. Now, Giorgio, on your taxes last night, see, Kevin, you didn't do taxes last night, did you?